There is a number sitting in a Wall Street risk report right now that says $33 trillion could vanish from the US economy, more than the entire GDP of America, if the AI trade unwinds the way analysts think it will. And here's the part they didn't tell you. If you have a 401k, an index fund, or a target date retirement account, you already own this bet. You didn't choose it. It was made for you. Stick around, because by the end of this video, you'll know exactly how exposed you are and the 3 moves you can make this week to protect yourself. Back in 2023, tech CEOs promised us AI would pay for itself. Faster productivity, faster growth, faster profits. That was the pitch that sent trillions of dollars pouring into chips, data centers, and AI startups. Fast forward to late June 2026. In 1 week, South Korea's entire stock market had to halt trading. The Nasdaq dropped over 2% in a single day. Oracle had its worst week since the dot-com crash. This wasn't a rumor, it happened. So here's the real question. This video is going to answer not is AI a bubble, because everyone's already arguing about that. The real question is how much of your money is quietly riding on the answer, and what do you actually do about it? Here's the official story. Companies like Microsoft, Amazon, Google, and Meta say they are spending big on AI because the productivity gains will be massive, and whoever builds the infrastructure first wins the future. Here's the mechanism underneath that story. These companies are stuck in what economists call a prisoner's dilemma. Nobody wants to be the one company that underinvests and gets left behind. So everyone overinvests at the same time. Even executives will privately tell you some of this money gets wasted. Combined, the 4 biggest hyperscalers are on pace to spend around $725 billion this year alone, and that number keeps climbing. Think of it like a poker table where every player keeps raising, not because their hand is great, but because they're terrified of folding while everyone else stays in. Now here's the part that should actually worry you. A huge and growing chunk of this spending isn't coming from company profits anymore. It's coming from debt, some of it stacked in complex off-balance sheet financing deals that look uncomfortably similar to what banks were doing with mortgages before 2008. Analysts estimate more than $6 trillion in AI-related infrastructure funding will be needed by 2030, and a rising share of that is borrowed money, not cash sitting in the bank. So who wins if the AI bet pays off? The chip makers, the cloud giants, and early investors. First, who's exposed if it doesn't? The lenders who finance the data centers, and everyday investors like you, who own these stocks through index funds, whether you realize it or not. Nvidia alone recently made up over 7% of the entire S&P 500. That's not a side bet anymore. That's the market. Now, let's slow down, because the headline in this video's title, $33 trillion gone, needs an honest asterisk, and I'd rather earn your trust than bait you. That $33 trillion figure is not money that has already disappeared. It's a projection from risk analysts at Oliver Wyman, describing what could be wiped out in a worst-case dot-com-style AI equity crash based on today's valuations. It hasn't happened. What has actually happened is a real, but smaller, correction. The late June sell-off, chip stocks losing double digits in days, a handful of very bad weeks for AI-heavy companies. Here's what's also true and rarely gets said. This isn't 1999 all over again. Unlike the dot-com companies that had no revenue, today's AI leaders, Nvidia, Microsoft, even Anthropic, are actually profitable, with real paying customers. Some analysts at BlackRock and Fidelity argue current valuations, while stretched, haven't reached dot-com extremes, and most of this year's spending has been funded by real earnings, not just debt, for now. So what actually changed isn't a doomsday event. What changed is certainty. A few months ago, AI keeps growing forever felt like a safe assumption baked into everyone's portfolio. Now, serious institutions, the Bank of England, the IMF, Michael Burry, even Jamie Dimon, are openly saying the risk of a real correction in the next 2 years is higher than markets are pricing in. That shift from certainty to real doubt is the actual story. Let's make this concrete. 3 ways this actually touches your life. Number 1, your retirement account is more exposed than you think. If you own a basic S&P 500 index fund, roughly a third of it is effectively riding on 7 companies and the AI story they're telling. A plain Nasdaq fund is closer to 40%. In real life, that means a sharp AI correction doesn't just dent tech stocks. It can knock 10 to 15% off the total value of a completely boring, diversified retirement account you thought was safe. Number 2, prices you didn't expect are already moving. AI's hunger for chips and data centers is quietly pushing up the cost of memory chips, electricity in data center heavy states, and even consumer electronics. Apple has already pointed to rising chip costs as a reason for price increases. In real life, that shows up as a slightly higher bill on your next phone, laptop, or even parts of your electricity bill if you live near a major data center hub. Number 3, this touches jobs, not just portfolios. A Harvard economist estimated AI-related infrastructure spending accounted for the overwhelming majority of US GDP growth in the first half of 2025. That's great on the way up, but it means if AI investment slows or reverses, the drag on hiring and wages won't stay confined to Silicon Valley. In real life, that could mean slower hiring, smaller raises, or layoffs rippling into industries that have nothing to do with AI on the surface. Construction, energy, logistics, even local retail near data center towns. Here's what you actually do about it. 5 steps in order of urgency. 1. Check your real tech exposure this week. Log into your 401k or brokerage account and look up what percentage sits in tech or growth funds versus everything else. If it's north of 35 to 40%, you're more concentrated in this one story than you probably intended. 2. Don't panic sell, rebalance instead. Selling everything now locks in losses and misses any upside if AI keeps delivering. Instead, if you're overweight tech, consider trimming back toward your original target allocation. Even a 5 to 10% rebalance toward bonds, international stocks, or value sectors meaningfully lowers your single-story risk. 3. Build or top up a 3 to 6 month emergency fund now, not later. If AI-driven spending really has been propping up a big chunk of GDP growth, a slowdown could hit jobs before it fully hits headlines. Having 3 to 6 months of expenses in cash means a shaky job market becomes an inconvenience, not a crisis. 4. If you're within 10 years of retirement, get a second look at your glide path. Target date funds automatically shift you toward bonds as you age, but confirm yours has actually adjusted and isn't still carrying an outsized tech bet this close to when you'll need the money. 5. Watch AI company earnings calls, not just stock prices, for the real signal. The number that matters isn't the stock price swinging day to day. It's whether revenue and profit from AI products keep growing quarter over quarter. When that growth clearly stalls while spending keeps rising, that's the moment risk stops being theoretical. Keep an eye on it, and I'll keep tracking it here too. Here's the honest version of this story. AI probably isn't a scam and it probably isn't going to zero, but the money attached to AI got ahead of the proof attached to AI. And a lot of that gap is sitting quietly inside accounts people were told were safe and diversified. The takeaway isn't fear, it's this: know what you own. Size your risk on purpose and keep some dry powder ready, because the people who do well in every bubble, real or not, are the ones who checked their exposure before the headlines forced them to. And if you want to stay ahead of where this AI story goes next instead of finding out from a scary headline, hit subscribe. That's exactly what Dollar&Demand is for. I'll see you in the next one.